So today is April 22, 2026, and we're looking at Nokia,
Yeah.
which, yeah, is the company that probably made your first, like, indestructible cell phone.
Oh, definitely. The classic brick.
Exactly. Well, they closed at $10.20 yesterday. That's a slight daily dip of about 1.89%, but the stock is hovering dangerously close to its 52-week high of $10.69.
Right. It's right up against that ceiling.
It is. And looking at the absolute chaos in the data we've gathered for you today, I just have to ask, is this a falling trend, flashing sell signals, or, a strong buy that's somehow still wildly undervalued?
Well, I mean, that is the multi-million-dollar question, keeping, institutional algorithms and retail day traders up at night right
Oh,
now.
yeah,
We're looking at a market setup that is fundamentally just at war with itself.
totally. And before we get into the weeds and untangle that war, I need to ask you, listening right now, a quick favor. Like the video, subscribe to our YouTube channel, and you absolutely must leave your comments and feedback below.
We really want to know what you think about this setup.
Yeah, we want your take as we go through the data, because today's deep dive is built on a massive stack of conflicting
It
intelligence.
really is. The sources we pulled paint two entirely different realities.
Completely. We have fresh financial statements, technical order flow charts, and analyst ratings that are so sharply divided they literally look like they're evaluating two different companies.
Right.
And our mission today is to equip you with the hard mechanics behind Nokia's recent 100% stock surge. And we have to do it quickly because we are sitting exactly 24 hours away from a massive earnings catalyst.
Exactly. Tomorrow morning changes everything. But, to understand the stock's wild momentum leading into tomorrow, we have to look under the hood at the core financials from fiscal year 2025 and the fourth quarter.
Okay, let's unpack this because I want to lay out the baseline numbers first.
Sure, go ahead.
Over the last 52 weeks, Nokia's stock has ranged from a low of $4 all the way up to that $10.69 peak. Revenue came in at 19.89 billion euros, which is roughly 21.4 billion US dollars.
Right, which is huge.
Yeah. And in a legacy telecom sector that is notoriously stagnant, their Q4 comparable sales actually grew 3% year over year.
And see, that 3% growth is really the anchor for the bullish argument.
Okay, how so?
Well, telecom networks are incredibly expensive to upgrade, right? So generating any organic sales growth means they are actively taking market share from competitors, like, say, Ericsson.
That makes sense. They also reported their gross margin expanding by nearly a full percentage point, 90 basis points, landing at 48.1%.
Yeah, which is solid.
So they're growing sales and they're making a slightly better profit on the actual physical hardware and software they sell.
Exactly. That gross margin expansion tells us their supply chain costs are stabilizing and, they have pricing power. They aren't just slashing prices to move inventory.
Right. But here is the glaring contradiction that jumped out at me immediately.
Uh-oh.
If sales are growing and your profit margins on those specific sales are expanding, how did Nokia's net income plummet from 4.25 billion euros down to just 651 million for the year?
Yeah, that is the elephant in the room.
Is this like successfully raising the rent on your apartment building, filling all your vacancies, but somehow your yearly take-home cash still drops by 85%?
Huh.
The math just feels broken.
Okay, so if we connect this to the bigger picture, think of it less like a standard apartment building and more like a total teardown.
A teardown.
Yeah. You raised the rent, sure, but you also decided to completely gut the building's infrastructure, replace all the plumbing, and install cutting-edge server racks in the basement.
Oh, wow. Okay.
Gross margin just tells us the rent is profitable. The net income drop reveals the harsh reality of their corporate restructuring.
So the business of selling telecom gear is healthy on a per-unit basis, but the corporate overhaul is acting like this massive financial anchor weighing down the bottom line.
Precisely. The pivot from being a legacy telecom vendor to an AI infrastructure player that requires billions in capital. You have to spend a fortune on research and development, operational overhauls, integrating new acquisitions. That restructuring eats your cash alive, which is exactly why net income took that 85% haircut.
But wait, doesn't a massive cash burn like that raise immediate bankruptcy flags? If I see an 85% drop in net income, my first instinct is that the company's bleeding out.
Naturally, yeah. But you have to measure that cash burn against their balance sheet, which is currently built like a fortress.
A fortress. Let's hear the numbers.
As of December 31st, 2025, Nokia holds total assets of 37.60 billion euros against total liabilities of only 16.54 billion.
Wow. So they essentially have twice as many assets as they do debts.
They do, and they maintain a net cash balance of 3.4 billion euros, plus they managed to generate 0.2 billion in free cash flow in Q4 alone.
Okay, so they're still bringing in cash.
Right. Free cash flow is the actual usable cash left over after paying for all those heavy capital expenditures.
Mm.
So while the net income metric looks terrifying, they aren't actually strapped for cash. They have the war chest to fund this AI pivot without drowning in high-interest debt.
Which brings us to a massive disconnect in our sources. We've seen these mixed fundamentals, the great balance sheet, but the shrinking net income. Yet the market seems to be completely ignoring the fact that they lost 85% of their net income.
Completely ignoring it.
Let's move from the ledger to the charts, because the price action is aggressively positive.
Well, the stock market is a forward-looking mechanism, right?
Yeah.
The income statement we just discussed is a reflection of the past year's painful restructuring. The charts are pricing in the future capacity of the new business model.
The trading volume alone shows massive institutional interest. I mean, we are seeing 61.59 million shares traded recently, which sits higher than its already heavy three-month average of 57.34 million.
That's a lot of volume.
It is. The trend is undeniably bullish. The stock is up over 30% in the last 6 months and up nearly 60% over the last year. But who exactly is buying and at what levels?
So when you map out the order flow, you can really see the distinct battle lines between the buyers and the sellers.
Yeah, there's active aggressive support at $8.30, which acted as a previous breakout zone, and strong buying at $7.89.
And for the technical traders listening, that $7.89 mark is the 20-day moving average.
Right, which is crucial.
Exactly. That 20-day moving average acts as a dynamic floor. Every time the stock dips near that line, algorithmic trading bots and momentum traders step in and swallow up the available shares, viewing it as a short-term discount.
But on the flip side, there is this massive resistance wall of selling right at the $10.67 to $10.69 barrier.
Yep.
The stock just simply cannot break through it.
Human psychology and algorithmic programming collide at that specific level because, as you mentioned, $10.69 is the 52-week high. Traders look at that peak and think, okay, this is where the rally died last time, I better take my profits. And institutional algorithms are explicitly programmed to trim positions near those double top resistance levels to mitigate risk.
Yet the momentum indicators are largely screaming buy. Let's look at the moving averages.
Okay.
The 5-day average is at $10.45, the 50-day is at $10.30, and the 200-day is trailing way down at $8.93.
And standard technical analysis views that specific alignment as highly bullish.
Oh, completely.
When the short-term average is stacked above the medium term and both are above the long term, it signals that buying pressure is consistently accelerating over time. The trend is fundamentally intact.
But here is where the data gets incredibly messy. Let's talk about the Relative Strength Index.
The RSI.
The RSI.
Right.
For those following along, the RSI measures the speed and magnitude of recent price changes to evaluate if a stock is overvalued or undervalued in the short term. Some trading platforms are showing Nokia's RSI at a perfectly neutral 55.19. That implies a healthy, sustainable trend with plenty of room to run.
Right. A neutral RSI means the buying pressure hasn't reached a state of exhaustion.
However, other platforms we pulled data from are flagging the RSI peaking all the way up at 72.75.
Ooh, yeah.
And anything over 70 is traditionally considered overbought. It's a sell signal. Instead of the tired old rubber band metaphor, think of a sprinter who has run so fast, so deep into the red zone, that their muscles physiologically must pause to clear lactic acid before the next leg of the race.
That's a great analogy.
The momentum just cannot be sustained without a pullback.
And what's fascinating here is that divergence in RSI data creates a massive technical tug of war. And we see that same tension with the MACD, the moving average divergence.
Yeah.
The MACD looks at the gap between a short-term moving average and a long-term one. When that gap widens, it tells us momentum is accelerating.
And our sources show the MACD at 0.052,
Right.
which technically triggers a buy signal.
It does trigger a buy, yeah.
Yeah.
But digging into the specific volume behind that MACD reading, there are underlying weakness signals.
Oh, really?
Yeah. The buying volume is starting to thin out as the price rises. This warns of an unsustainable extreme rally that may very soon stall out or trade completely sideways as the buyers run out of ammunition.
Man. This technical tug of war perfectly mirrors the total chaos we're seeing in the analyst community right now.
It's completely split.
It is. Let me give you the most bizarre fact from our sources today. If you look at Wall Street, the general consensus rating for Nokia right now is a buy. Sounds incredibly positive for the stock, right?
It sounds positive until you read the actual price targets attached to those ratings.
Exactly. So what does this all mean? The consensus buy rating actually comes with an average price target of $8.70.
Wait.
Yeah. You, listening right now, know the stock is currently trading at $10.40. That means Wall Street analysts are officially telling clients to buy a stock that their own models predict will drop by almost 18%.
It's completely backwards.
How does a buy rating imply an 18% downside risk?
Well, it really exposes the lag in institutional financial modeling. Discounted cash flow models take time to update, and they require hard quarterly data.
Ah, okay.
The analysts still like the underlying fundamentals of the company, hence the buy rating, but their rigid valuation models haven't caught up with the market's explosive enthusiasm over the AI pivot.
Not everyone is lagging, though. We have some high flyers in the mix. Northland has a price target of $13, and Bank of America is right behind them at $12.40.
Those are bold targets.
But this huge spread in targets feeds into a massive natural debate going on right now. Is Nokia truly undervalued, or is it a giant value trap? Let's look at the trap side first.
Okay, so Guru Focus ran their proprietary models and came out swinging. They estimate Nokia's fair fundamental value is only $4.57.
Wow. They're literally labeling the stock 125.2% overvalued at current prices. That is a terrifying metric if you're holding shares at 1040.
It is, but Guru Focus is heavily weighting that 85% drop in net income we discussed earlier.
Right.
Their models prioritize the actual cash hitting the bottom line today, completely discounting the promised cash flows of tomorrow's AI innovations.
But then you have the undervalued side of the debate. Zacks Research recently gave Nokia an A for value.
An A.
Yeah, an A. They awarded that grade because late last year, Nokia's price-to-earnings ratio was significantly lower than the broader telecom industry average. They see a company that was temporarily priced for bankruptcy, but is actually growing comparable sales and expanding margins.
This raises an important question about internal corporate sentiment, though.
How so?
Well, if the stock is such an incredible value, as Zach suggests, or on the verge of a massive AI breakout to $13, why aren't the insiders buying their own stock?
Oh. According to our sources, there has been zero reported insider buying in the last 3 months.
Zero.
No executives, no board members scooping up shares on the open market.
And the silence from management's own personal portfolios speaks volumes. If you're a CEO or a CFO and you genuinely believe your new networking partnership is going to push your stock significantly higher, you usually buy shares.
Yeah, you don't just issue press releases.
Exactly. The lack of insider buying raises serious questions about their true confidence at these $10+ price levels.
They're happy to sell the narrative to the public, but they aren't reaching into their own wallets.
That's what it looks like.
To figure out if this setup is a trap for regular investors, we have to stress test the two extremes, the best case recovery scenario against the worst case continuation lower.
Let's do it.
Let's start with the bull case. Here's where it gets really interesting. The bullish narrative is no longer about making cell phone towers or legacy 5G equipment. Nokia is pivoting to become an optical powerhouse for AI data centers.
And that pivot completely changes their valuation model. Artificial intelligence doesn't just run magically in the cloud. It requires massive physical data transfer. You need incredibly advanced, high-bandwidth optical networking to connect thousands of GPUs working simultaneously, which is exactly the infrastructure Nokia is building.
And the technical traders love this fundamental pivot because it perfectly aligns with a massive cup-and-handle breakout pattern on the long-term charts.
Yeah, the cup and handle is one of the most reliable bullish continuation patterns out there.
It really is.
It illustrates a long period of stock consolidation forming a rounded cup bottom, followed by a slight brief pullback, which is the handle. That handle represents the stock gathering energy and shaking out weak hands before a massive upward surge.
And that pattern is completely fueled by a highly publicized partnership with Nvidia. I mean, if Nokia successfully becomes the literal plumbing for Nvidia's AI data centers, a $10 stock price will look like an absolute steal in 5 years.
That is the optimistic scenario for sure, but we have to look at the bear case. And more importantly, the specific mechanics of why retail traders often get trapped in setups exactly like this one.
Walk us through the trap. How does the average investor get crushed here?
Well, retail investors open their social feeds and they see keywords like Nvidia and AI attached to a stock that only costs 10 bucks.
Yeah,
They think, wow, it's a cheap stock. I can buy 100 shares for $1,000. They completely confuse share price with company valuation.
which happens all the time.
They ignore the fact that Nokia has billions of shares outstanding, giving it a massive market cap in the tens of billions. It is not a small, nimble startup.
They see a 100% stock surge over the past year and suffer from intense FOMO fear of missing out.
Yep.
So they buy at the absolute top of the chart.
They buy at $10.60, providing perfect exit liquidity for the institutional algorithms. Retail traders completely ignore the fact that Nokia's trailing price-to-earnings ratio is stretched to roughly 78x.
Let's translate that metric for a second. A 78x PE ratio means you're paying $78 for every $1 of earnings Nokia generated over the last year.
Yes, you're paying a massive premium for growth, while the company currently has negative earnings growth. Remember that 85% net income drop we talked about?
Ah, right.
Retail buys the buzzwords, while the smart money looks at that 78x PE ratio and prepares to take profits.
Which makes the timing of everything we're discussing so incredibly critical. All the speculation, the tension in the charts, the divergent analyst models, it all comes to a head in less than 24 hours.
The ticking clock.
Let's look at the future outlook. In the immediate short term, Nokia's Q1 2026 earnings drop tomorrow morning, April 23, 2026.
And earnings reports act as the ultimate truth serum for a highly speculative stock.
The street is officially expecting $5.40 billion in revenue and 6 cents in earnings per share. This is the immediate volatility risk for you as a listener.
Exactly.
If they miss that modest 6-cent EPS target, or if their forward guidance doesn't sound confident enough about the AI transition timelines, all that unsustainable extreme rally tension we saw in the charts could violently snap downward.
But, if we pull back to the medium and long-term outlook, tomorrow's earnings report is just one battle in a much longer war. The real long-term growth hinges on executing their AI-RAN collaborations.
AI-RAN stands for Artificial Intelligence Radio Access Network, right?
That's right. They are partnering with Nvidia and telecom giants like Orange to essentially make wireless networks dynamically intelligent.
How does that work?
Well, instead of broadcasting signal blindly, the network uses AI to route bandwidth in real time based on demand, which saves telecom companies massive amounts of power and operating costs.
Plus, they have the ongoing integration of Infinera, which is the optical networking company they acquired, to boost the physical fiber capacity we talked about earlier.
The technology is sound, there's no doubt, but the long-term risks are heavy.
Like what?
Nokia faces extreme revenue volatility because they rely entirely on the capital expenditure cycles of major cellular carriers. If AT&T or Verizon decides to cut back on upgrading their networks next year due to, say, high interest rates, Nokia's revenue takes an immediate, uncontrollable hit.
Yeah, that makes sense.
Plus, they are operating in a fiercely competitive 5G and 6G space against giants like Ericsson and emerging tech challengers. The AI pivot is brilliant in theory, but it is incredibly expensive and risky to execute in practice.
Which brings us to the most important part of this entire deep dive. A quick reminder that everything we have discussed today, this natural debate between the technical charts, the fundamental balance sheets, and the divergent analyst ratings, is purely for educational purposes.
Yes, absolutely.
We are dissecting the data so you can understand the mechanics of the market, but this is absolutely not financial advice.
Every investor has to evaluate their own risk tolerance, especially when staring down the barrel of an unpredictable earnings report.
Exactly. And as we leave you today, facing down tomorrow's critical earnings call, I want to leave you with one final thought to ponder. We started by looking at a legacy company undergoing a massive, painful restructuring. So here is the question. If a legacy tech giant can lose roughly 85% of its net income in a single year, yet watch its stock surge 100% purely on the promise of an AI pivot, are we witnessing a brilliant corporate turnaround that will define the next decade of infrastructure? Or are we just repeating the speculative traps of the dot-com bubble, buying the hype instead of the math?
That's the million-dollar question. The historical fundamentals and the futuristic narrative are on a direct collision course tomorrow morning. It's going to be a fascinating watch.
Keep questioning the data, keep looking past the headlines, and we will see you on the next deep dive.